The $2,100 combined pension hack. How much exactly is your Feb 25th deposit? There's a number being discussed quietly among Canadian pension analysts right now. $2,100. Some retirees are seeing it, others are not. And what makes this particularly concerning is that February 25th is now less than 2 weeks away, and many Canadians still don't understand exactly what they're supposed to be receiving or why their deposit might look different than their neighbors. This isn't about a new government announcement. This is about how existing pension rules, benefit stacking, and income thresholds are creating dramatically different outcomes for Canadian seniors who, on paper, appear to be in similar situations. My name is Joseph, and over the next several minutes, we're going to break down exactly what this $2,100 figure represents, who qualifies, who doesn't, and why understanding these details now could mean the difference between financial security and unexpected shortfalls in retirement. Because here's what's becoming clear. Most Canadians don't fully understand how their pension income actually stacks together. Let's start with what we know. Right now, millions of Canadian seniors receive some combination of 3 federal income sources: Canada Pension Plan, Old Age Security, and for those with lower incomes, the Guaranteed Income Supplement. These aren't new programs. CPP has existed since 1966, OAS since 1952. GIS was added in 1967 to support the most vulnerable seniors. But what's changed, particularly over the last 18 months, is how these programs interact with each other in terms of total monthly income, and how inflation adjustments, clawback thresholds, and income testing are creating vastly different outcomes for retirees. In January 2026, we saw another round of indexing adjustments tied to the Consumer Price Index. CPP increased slightly, OAS increased, GIS calculations shifted based on updated income data from the Canada Revenue Agency. And that's where this $2,100 figure comes into play. It's not a single payment. It's not a new benefit. It's the approximate combined maximum that certain Canadian seniors can receive each month when all 3 income sources are optimized under current rules. But here's the issue. Only a very specific subset of retirees actually reach that threshold, and many who believe they qualify are discovering they don't, often because of small amounts of additional income that trigger reductions they didn't anticipate. Pension policy experts have been pointing this out for years. The system is complex, the rules are layered, and the communication from government has been, to put it generously, inconsistent. Dr. Margaret Yao, a retirement income researcher based in Toronto, published analysis last year showing that nearly 40% of GIS-eligible seniors either don't apply or misunderstand how employment income, RRSP withdrawals, or even CPP itself can reduce their GIS entitlement. That's not a small number. That's hundreds of thousands of Canadian households making financial decisions based on incomplete information. So, when we talk about a $2,100 combined pension strategy, what we're really discussing is how to navigate a system that was built in pieces over decades and never fully harmonized. Let me be very clear about something. There is no single government program paying out $2,100 per month to every senior. What we're talking about is the theoretical maximum combined income from CPP, OAS, and GIS for someone who qualifies under very specific conditions. Here's how it breaks down as of February 2026. Canada Pension Plan. The maximum monthly CPP retirement benefit for someone starting at age 65 in 2026 is approximately $1,364, but very few Canadians actually receive the maximum. The average is closer to $815 per month. To get the maximum, you need to have contributed at the maximum pensionable earnings level for at least 39 years, which most working Canadians have not done. Old age security? The maximum monthly OAS payment for someone aged 65 to 74 is approximately $713 as of early 2025. If you're 75 or older, you receive a 10% increase, bringing it to roughly $784 per month. OAS is available to nearly all Canadian seniors who meet residency requirements, but it begins to be clawed back if your individual net income exceeds approximately $86,900 annually. Guaranteed Income Supplement. This is the most misunderstood piece. GIS is income tested, meaning it's designed for seniors with little or no income beyond OAS. The maximum monthly GIS for a single senior with no other income is approximately $1,065. For couples, the calculation changes based on combined household income. Now here's the critical point. You cannot receive maximum CPP and maximum GIS at the same time. They are inversely related. If you're receiving $1,364 per month in CPP, your income is far too high to qualify for meaningful GIS support. GIS begins reducing by 50 cents for every dollar of additional income beyond OAS. So where does the $2,100 figure come from? It represents an optimized scenario where a Canadian senior receives moderate CPP, full OAS, and partial GIS, bringing total combined monthly income to approximately $2,100. For example, someone receiving $600 in CPP, $713 in OAS, and roughly $787 in GIS would land near that $2,100 threshold. But achieving that balance requires precise income management, and it's extremely sensitive to other income sources. If you have even modest RRSP withdrawals, rental income, or part-time employment, your GIS can drop significantly or disappear entirely. This is what pension analysts are calling the benefit cliff. A small increase in income can trigger a disproportionate loss in GIS, leaving some retirees financially worse off for earning more. So, who exactly is impacted by this? First, low to moderate income Canadian seniors. If your only income in retirement is CPP and OAS, you likely qualify for at least partial GIS. But if you're supplementing that with registered savings, non-registered investment income, or workplace pension income, your GIS entitlement may be reduced or eliminated. Second, retirees who worked part of their careers in Canada, but not their entire lives. If you immigrated to Canada later in life or spent significant time working abroad, your CPP contributions may be lower, which could make you more reliant on GIS to maintain a basic standard of living. Third, surviving spouses. When one partner dies, household income changes dramatically. CPP survivor benefits exist, but they don't fully replace the deceased partner's income. Meanwhile, GIS eligibility is recalculated based on the survivor's new individual income, which can lead to unexpected benefit changes. Fourth, Canadians in their early 60s who are deciding when to start CPP. Taking CPP at 60 reduces your monthly payment by 36% compared to waiting until 65. But for someone who qualifies for GIS, taking reduced CPP early might actually result in higher combined income because it preserves more GIS eligibility. That's counterintuitive, and it's exactly the kind of detail that isn't widely communicated. Fifth, seniors living in provinces with additional provincial top-ups to GIS. Several provinces, including Ontario, British Columbia, and Quebec, offer their own supplements for low-income seniors. These interact with federal GIS in complex ways, and changes to federal benefits can trigger changes to provincial ones. Finally, Canadians who are still working past 65, you can collect OAS and CPP while still employed, but your income will almost certainly disqualify you from GIS. However, once you stop working, there's often a lag before GIS kicks in because it's based on your prior year's tax return. All of these groups are navigating a system that requires them to understand not just one program, but how multiple programs interact dynamically based on income reported to the CRA. Let's talk real numbers. If you're a single senior receiving the optimized $2,100 per month in combined benefits, that's approximately $25,200 per year. That's just above the federal poverty line for a single person, which sits around $24,000 depending on the region. In other words, Even at the maximum combined benefit level, Canadian seniors are living modestly. But here's where the financial impact becomes more significant. If your income increases by just $2,000 per year perhaps, from a small RRSP withdrawal or part-time work, you could lose up to $1,000 in GIS annually because of the 50% clawback rate. That's an effective marginal tax rate of 50% before you even factor in income tax. For many seniors, this creates a disincentive to save or work, which pension economists have been warning about for years. Consider this scenario. Maria is 68 years old. She receives $650 per month in CPP and $713 in OAS. Based on her income, she qualifies for $740 per month in GIS. Her total monthly income is $2,103. Her friend Antonio, also 68, receives $950 per month in CPP because he contributed more during his working years. He receives the same $713 in OAS, but his higher CPP reduces his GIS to $590 per month. His total monthly income is $2,153. Antonio contributed significantly more to CPP over his lifetime, yet his total retirement income is only $150 per month higher than Maria's. That's $1,800 per year, a modest return for decades of higher contributions. This isn't a flaw in the system per se. GIS is designed to provide a floor of income security. But it does mean that middle-income Canadians who saved moderately often end up in a compressed income band with those who saved very little. Now let's look at the February 25th deposit specifically. Most federal benefits are paid on a predictable schedule. CPP and OAS are typically deposited on the third to last banking day of each month. GIS follows the same schedule. For February 2026, that means the 25th. If you're receiving combined benefits, you should see separate deposits for CPP and a combined OAS-GIS payment. The amounts should reflect the January 2026 indexing adjustments. If your deposit is significantly different from what you expected, there are a few common reasons. Your income information from your 2023 tax return was recently processed by CRA, and your GIS was recalculated. You turned 75 and your OAS increased, but you didn't notice. You had a change in marital status that affected your GIS entitlement, or there was an overpayment in a previous period, and CRA is recovering it through reduced payments. These adjustments are rarely communicated proactively. Most seniors only find out when they check their bank account. So why does the system work this way? The short answer is fiscal sustainability and targeting. The Canadian government currently spends over $70 billion annually on OAS and GIS combined. CPP is technically separate, funded through contributions, but it's still a massive public pension system. With Canada's population aging rapidly, the number of seniors is expected to double over the next 25 years. That puts enormous pressure on federal finances. GIS, in particular, is expensive. It's a purely tax-funded benefit with no contribution requirement. The government has a strong interest in ensuring that GIS dollars go only to those who truly need them, which is why the income testing is so strict. There's also a policy philosophy at play. Canadian retirement income policy is built on 3 pillars: government benefits like OAS and GIS, employer and personal pensions like CPP and workplace plans, and private savings like RRSPs and TFSAs. The idea is that each pillar supports different income levels. GIS is the safety net. CPP is the foundation. Private savings are the supplement. But in practice, these pillars don't always work together smoothly, especially for middle-income Canadians who fall between the cracks. Some policy analysts argue that GIS clawback rates are too aggressive and should be reduced to encourage saving and work. Others argue that without strict income testing, GIS costs would explode and the program would become unsustainable. There's no easy answer. What we do know is that the government has been tightening eligibility and enforcement in recent years. CRA is more aggressive about verifying income, recalculating benefits, and recovering overpayments. Automated systems flag discrepancies more quickly than they used to. This isn't necessarily punitive. It's a reflection of fiscal reality. But it does mean that seniors need to be more careful about understanding how their income is reported and how it affects their benefits. Pension experts have been sounding the alarm about these issues for years. The National Institute on Aging published a report in 2023 calling for a comprehensive review of how GIS interacts with other retirement income sources. They specifically highlighted the benefit cliff problem and recommended smoother clawback rates. The Canadian Association of Retired Persons has repeatedly called for better communication from Service Canada about benefit calculations. They point out that most seniors receive only a generic letter with a dollar amount, with no clear explanation of how that amount was determined. Provincial governments have also raised concerns. Quebec, for example, has its own parallel pension system and has argued that federal changes to OAS and GIS create administrative complexity and confusion for Quebec seniors. Advocacy groups representing low-income seniors have pushed for increases to the GIS maximum, arguing that even the optimized $2,100 combined benefit is insufficient in high-cost cities like Toronto and Vancouver. Meanwhile, some economists argue that the system is actually too generous, and that Canada cannot afford to maintain current benefit levels as the population ages. It's a polarized debate, and there's little political consensus on how to reform the system. What's clear is that the status quo is confusing, opaque, and prone to creating unintended consequences for individual retirees. So what should you do if you're approaching retirement or already receiving benefits? First, understand your own numbers. Log into your My Service Canada account and review your current CPP, OAS, and GIS amounts. Make sure you understand why you're receiving what you're receiving. Second, request a detailed calculation if something doesn't make sense. Service Canada is required to provide an explanation of how your GIS was calculated if you ask for it. Don't assume the system is correct. Errors do happen. Third, be strategic about when you start CPP. If you expect to qualify for GIS, running the numbers with a financial planner or using online calculators can help you determine whether taking CPP early, at 65, or later results in higher total income. Fourth, understand how other income affects GIS. Even small amounts of employment income, RRSP withdrawals, or investment income can reduce your GIS significantly. In some cases, it may make sense to delay withdrawals or structure income differently to preserve GIS eligibility. Fifth, file your taxes every year, even if you have no income to report. GIS eligibility is determined based on your tax return. If you don't file, your GIS will be cut off automatically. Sixth, if you're married or in a common law relationship, understand that GIS is based on combined household income. Your partner's income affects your benefit, even if you keep finances separate. Seventh, stay informed about indexing changes. Benefits are adjusted every January based on inflation. These adjustments are automatic, but you should verify that they're applied correctly to your account. Eighth, if you're caring for a spouse or dealing with a death in the family, notify Service Canada immediately. Survivor benefits and GIS recalculations can take months to process, and delays can create financial hardship. Ninth, be cautious about advice from non-experts. The rules are complex, and well-meaning friends or family members may not fully understand how the system works. Finally, consider working with a certified financial planner who specializes in retirement income. The cost of professional advice is often far less than the cost of making a mistake that reduces your benefits for years. Looking ahead, there are a few scenarios worth watching. First, further indexing adjustments. Inflation has moderated compared to 2022 and 2023, but prices are still rising. CPP, OAS, and GIS will continue to be adjusted annually, but those adjustments may not keep pace with real cost of living increases, particularly in housing and healthcare. Second, Potential policy reforms. There's growing pressure on the federal government to simplify the retirement income system and address the benefit cliff issue. Whether that results in meaningful change remains to be seen, but it's something to monitor, especially heading into future federal elections. Third, provincial top-ups. Several provinces have indicated they may expand their own supplements for low-income seniors. If you live in a province that offers additional benefits, stay informed about eligibility and application processes. Fourth, increased CRA scrutiny. As the government faces fiscal pressure, expect continued or even heightened enforcement of income reporting and benefit eligibility. Make sure your tax filings are accurate and complete. Fifth, demographic shifts. As more Canadians retire, competition for government resources will intensify. Benefits that seem secure today may face pressure in the years ahead. The reality is that the Canadian retirement income system is under strain. It was designed for a different era, with different demographics and different economic conditions. Whether it can adapt to meet the needs of current and future retirees is an open question. So let's come back to where we started. The $2,100 combined pension figure isn't a hack. It's not a secret government payment. It's the result of understanding how CPP, OAS, and GIS work together under very specific conditions. For some Canadian seniors, it represents the maximum they can realistically receive. For others, it's not achievable because their income is too high or too low. What matters most is that you understand your own situation, that you know what you're entitled to, how your benefits are calculated, and what changes could affect your income. February 25th is just another payment date. But if your deposit looks different than you expected, don't ignore it. Follow up. Ask questions. Get clarity, because in retirement, every dollar matters. And the system won't advocate for you. You have to advocate for yourself. If you found this breakdown helpful, please subscribe to the channel. Share this video with anyone you know who's navigating retirement or planning for it. And leave a comment below if you have questions or want us to cover specific aspects of Canadian pension policy in future videos. My name is Joseph. Stay informed, stay prepared, and I'll see you in the next one.